market. For example, I have this small paper, good and bad sides of it. Slovakia, the trading in currency euro. Good news, prospectus not required. This is actually all over European Union, and it is obviously good news. Very good support from the local authorities, friendly, and that is also very necessary prerequisite. Verbal confirmation enough for our admission to the market. Possibility of additional tap, okay. Full access of foreign investors, no problem. With clearing through both Euro funds investing. Bad news, no possibility of a Eurobonds-like program in Slovakia. If we take Romania, on good news, again, prospect, no problem with pension funds investing. Bad news, written permission to the market necessary. It takes time, and that depends on the country, from country to country bureaucracy. Specific parameters of the one-off issue need to be submitted from the very outset. Unreadiness of placement participants to implement initial and further trading in euro. Issues with access of other domestic bonds rather than Romanian government bonds. We tried Bulgaria, for example. There, the situation is a little less positive. Not so very good support from the local authorities. Written permission to the market necessary. No additional tap possible. Problems with pension funds investing. And also unreadiness of placement participants to implement initial and further trading in euro. So obviously our recommendation is there is a need for further unification of local requirements for different groups of issuers, corporate, borrowers, financial institutions, IFI. Obviously, what probably we see as a necessity is to make a single list of available debt instruments for raising funds on local markets. Necessary to set up uniform requirements for different group of issuers, as well as for different types of debt instruments, be it bond programs, green bonds, etc. Also, there is probably very strong need for unification of documentary requirements for admission to trading, because they all differ. Requirements for notarization, translation into different languages, it all differs.
So let me stop you right here. So actually administration, it's a burden also outside of the EU as it is in the EU, and Markus wanted to touch something on this one?
No, not on this one. But,
so please go ahead.
I mean, there's 2-3 things I wanted to underline. Number one, I mean, I think we have, and it has been more or less echoed by all colleagues, we have a problem of perception of capital. So insofar, I think Jonathan Hill is a blessing, because he understands that, I mean, this market, this single market, this European Union will not work without improvement of the perception of capital. So this is a very good thing. Then, and has been said, of course, and this links to it, we have a problem in the politicians. I mean, in many countries, you talk to members of governments and they're proud not holding stock. Because sometimes it's easier and then they don't have problems and they don't have to declare it. But of course, this is a major problem, because this will not bring us where we should go. Then we have a problem with risk. Of course, nobody, and how to tackle risk. Of course, we're not saying we should not manage the risk, and nobody says we should produce a subprime too. Of course, I mean, I think everybody has had the learnings, but we have this problem of the perception of risk. We have it as far as the capital market is concerned. We have it as far as innovation is concerned. We have it in all aspects, and if we don't overcome this, we will have a big problem in Europe, because we cannot exclude risk. I mean, of course, we have to manage risks, we have to assess risks, we have to control risks. But if we want to exclude risks ex ante, and this is very much the thinking of many policymakers in Europe, I mean, this is the end of progress. And what we will have to very clearly say as well, I mean, this will be the end of wealth as well. And one other point I wanted to touch upon is the financial transaction tax, because it has been raised by a number of colleagues, and just to underline that the European business community is heavily opposed to the financial transaction tax. It's a very strange animal, because, I mean, of course, there's now only 11 countries, which for my taste is still way too much, supporting it. But there are so many question marks. I mean, first, it's very clear that it will, before everything, raise the cost of finance. It will raise the cost of raising finance, is number one. Number two is it is totally unclear. I mean, we had a situation for a long time where at least the French were blocking the derivatives. Now we have a very strange situation where they, in a strange kind of package deal, with the climate change conference in Paris, which is something totally else. They gave up their opposition to this, which made the topic move forward. So at the time being, there's a clear and present danger that this moves forward, but I would totally agree with everything which had been said. I mean, this is a very dangerous instrument, because this is totally counterproductive. It can be very distortive, because it's totally unclear if it is introduced how this would affect those who are not participating, and it's simply the totally wrong message, and we'll continue to fight against it.
Would you widen it to all the 28 countries, or just get rid of it completely?
Cancel. I mean, the reason why it's not a proposal on behalf of the 28 is that, I mean, all the others do not agree.
And there are some clever countries around.
Yeah,
I can imagine
the majority,
that.
Yeah. But I mean, it would only have. I mean, this is a political thing. This is a thing where some kind of political punishment to what is politically suspected behind the financial crisis apparently needed to be invented. But I mean, if you look at it in substance, I mean, this is very harmful, very dangerous, and goes absolutely the wrong direction.
You mentioned risk, so I can assure you skin in the game is the basic principle for STS securitization, and there will be a lively discussion also on assets treatment and these kind of things, and also on synthesization. So because it's another subprime eventually for many things. Please.
Yes, I think it is right and it is prudent to say, if you are originating business and if you're originating risk and then you pass it on to somebody else who does not have the primary access to the customer and the business, that you keep skin in it. Yeah, that you say you do not sell off all of it, but you have a vital interest on the development of this portfolio. I think this is perfectly right. There is nothing bad in that. The brave hypothesis of this capital market union is still the same as in many, many other aspects of the European idea. You just, under commas, you just, so to say, lift the barriers, and then everything which is in this proportion and disparity will flow and it will be all the same all over Europe. We have seen this in other aspects of economic development, that it did not happen.
Okay.
We did not see in productivity, we did not see it in wealth development, we didn't see it in other aspects of EU. In this sense, the capital market union could be a bit easier, because money can move relatively fast. So, as it was said rightfully by Michael, if you have a saving mentality versus an investment mentality, the one will always keep sitting on his savings book, and the other one will look for new investment opportunities. Now, especially on SMEs in a stagnating economic environment, the question is who is willing to give more resources to allow growth? Now, from a bank perspective, we have learned our lessons. I'm fundamentally convinced if you borrow money, you have a duty to repay it. Yeah? Still, there is something like non-performing loans out in the world, and if you do your financial modeling, you have to assume how much of your loans that you're granting maybe will not come back. And this will give you the risk premium that you should prudently charge. That's the one element. The second element is how much debt is good for a company relative to its own risk-bearing capacity being defined by equity or any subordinated instruments. And here I would see a big potential. because many entrepreneurs are stuck in a way. They have invested the money they have, they make a moderate profit, but it is not enough really to take the company further to the next step. And if your equity is good for a loan of 100, it cannot be the solution to try to grow by taking up a loan for 200, simply because the correlation between own funds and equity relative to solid level of debt doesn't work. And here I believe that new instruments, new opportunities to give access also to Central and Eastern European countries, to offer investment opportunities within the EU to areas and places where there is more of an investment and risk-taking appetite than on a savings appetite, is definitely worthwhile the effort. So I think still, with all the problems and hindrances, I fully agree with what you said. It is a very good and ambitious idea and intention, and it would be great to see it happen.
Before we move on, anybody wants to ask a question, please?
There is another proposal in Brussels on the table which has to do with capital markets union, and on which maybe the Council will have some decisions very soon. Bank structural reform, meaning that banks are required to separate their investment banking from their retail or commercial banking proposals. Since this is such an excellent panel, I wondered whether anybody has a view on that, because you could argue to some degree the same things as what has been said about the financial transaction tax. So what does this panel think about bank structure reform? Should trading activities be entirely separated? Or say, first of all, be forbidden, and then if they are executed, they happen outside the bank?
Okay. I mean, if I may start from my simple non-regulatory point of view and then pass on to the really knowledgeable colleague. I take it as a valid political desire to say, if you have a banking industry and you have people who take their savings and give this to banks, you want to be sure that these savings are protected and safe and nothing can happen with it. And that you can be sure that the bank at every time is in the shape, supervision and position that the deposits are safe. Now, if we look at the financial crisis of 2007, I think two things at that time were different. Banks, to some extent, were moderately capitalized, so their risk-bearing capacity was relatively low, and one of the answers was to increase the capitalization levels of all banks, to make them more robust. Second to that, the question was how transparent and how predictable is a bank's balance sheet. And here I think it is a reality that you say you have a part of the bank's risk profile which is very predictable, because if you have a portfolio of mortgage loans with an average duration of 20 years, there is not much happening within a quarter or a year. And you can also see relatively clear the activities in private lending and in corporate lending. But the element which is very hard to follow also from a supervisor's perspective is the whole element of trading and investment banking, where within the limits that you give yourself, your risk profile can change very much, very fast. So from this perspective, I have some understanding that from a regulatory and protecting intention, you want to limit the potential maximum risk a bank can have in this component. Now, and I think there should be and must be an element for each and every bank to have trading opportunities, because otherwise you cannot fix your mismatch. You must have the possibility to trade currencies, to deal with your interest rate hedging, and so on and so forth. If you then say that can go up to a specific level, and this is fine as a universal bank, I think this is a prudent way. If you go so far that you really say a bank that has on the one hand a universal bank customer facing with corporate and retail, and on the other hand a relatively big investment arm that you really cut through and say this must be two banks, I find a relatively radical approach. And And I would rather expect that it goes through the level of thresholds from the total risk profile of a bank. But that is my view, and happy to say that this discussion for Raiffeisen is very theoretical, because each and every thresholds which are under discussion are way above our trading and investment banking activities, because we're really in the down on earth real financial needs and businesses of our customers. So it's no issue for us, but the academic discussion I find very interesting.
Satisfactory?
I'm not a banker, but if I may just quickly step in, I think it is nonsense. I mean, Mr. Lennkh is very elaborate, very polite, and as we talked about, I think it is simple nonsense. Because what are we doing today? We're kind of regulating and taxing down the banks to their almost insolvency, because we're taking all the money that they might earn away. We have regulations to put in place more and more and more that they cannot earn more. So what are we doing here? If we do the same thing now in splitting them up into two different things, it will be even worse. And then, I mean, you even use the word forbidding trading. I mean, right. It's right. But I mean, this is a crazy world we're living in. Sorry, I mean, there's only restrictions anymore. I mean, this is going to bring the real economy to an end as well. And we should always bear that in mind. But currently, the politicians are sitting there and saying, we are the savers of the world. There has been this incredible shift over the crisis from the economy, maybe sometimes dominating too much. I don't know, the politicians. I don't think so, but nevertheless. And now the politicians are very much kind of driving back the wagon by dominating business in a way. They say, we have been saving the banks, we have been saving the world, because the world would have been lost without us stepping in, helping the banks. And by this perfect marketing, what they're doing here on the political side all over Europe, we simply are forgetting, and this is actually their plan, we are forgetting that actually the whole crisis comes across because all of those governments all over Europe have been spending far too much money over the past decades than they actually earned. We have crises mainly now actually on a debt crisis on a government levels. I mean, look at Greece, look at all the other countries. This is the main problem, and we are discussing now having stronger restrictions on banks again.
Please, Markus, go ahead.
Well, very briefly to Karel's question. I mean, first, I think Peter might be right that part of the answer will lie in the thresholds, but we'll see. But to Karel's question, I mean, of course, the question we are at Business Europe asking ourselves is, will the split of universal banks help them to help the system to serve the real economy better? And our answer is no. So we don't think it's a good idea, because it will not lead to a situation where real economy will be supported better.
And maybe just to suit you, at this point, BSR is stalled, and some people hope maybe it will be withdrawn. So let's see what. BSR is stalled now, so there are no negotiations going on? No, yes. On the council level, no.
At least the parliament, I mean, Carsten, but I thought it was almost agreed.
No, definitely not. There is at least one issue, how you accommodate vicars, vice versa, the rest of the Europe, for example. Any more questions from the auditorium? Okay, if not,
can I follow up?
Sure, definitely.
I mean, maybe interesting to look at the United States, where for many decades we had the Glass-Steagall Act in place, and then in 1999, which separated the two functions that you alluded to, and then in the late 90s, 99 I believe, that act was effectively repealed. So, and now post-financial crisis, we went back to the Glass-Steagall world. So clearly in the US, I think people would be more sympathetic to the idea of separating the utility function of banking, sort of the deposit, kind of the part that has to be bailed out by the government if necessary, from the more speculative part that is more involved in trading and financial markets. So I don't know, I wouldn't call it complete nonsense. At least from the US perspective, it wouldn't be viewed that way. But of course, Europe has its own specifics, and universal banks have a much richer history here. If I may touch on a couple of other things that have been mentioned here in the panel earlier. So one was that 2019 might actually be too ambitious in terms of completing the capital markets union, because we have to harmonize all the laws, the insolvency laws and the tax laws and the accounting laws. And I wonder whether we really need to harmonize everything. I mean, everybody talks about harmonizing all these standards, but I think it would go a long way if instead of harmonizing, we simply clarified which rules apply in which situations. So imagine a Slovakian buying shares of a German company listed in London, okay? They might be reluctant to do this if they're uncertain about which country's rule will apply to this transaction. Is it German laws? Is it British laws? Is it Slovakian laws? If we could remove this uncertainty, this would have to be done top-down by simply specifying, okay, we all agree it's going to be the country of issuance. Or, I mean, if that uncertainty is removed, then I think harmonization is not all that crucial. And from that perspective, 2019 might be perfectly achievable. And one other point that was mentioned here was about the United States, how the average American talks about stocks after you spend 5 minutes with them, and that's absolutely true. And the reason is pretty obvious, because for over 3 decades, Americans have had private pensions. In the early 80s, private pensions were introduced, and now most people in the United States, myself included, have a pension, and we make our decisions any time, at any point. You decide how much to invest in stocks, which bonds, which mutual funds. You have to make your choices, and that is the best way to build literacy. In fact, building up upon this, I think one great thing we could do in Europe for the development of capital markets would be to develop portable private pensions, and this is something that is mentioned in the plan from the Commission. It is the one point I would highlight, perhaps above others, because if you have, first of all, if you have portable private pensions, these are vehicles in which people can save for their own retirement wherever they move within Europe. They can take them with them. This would be helpful not only for the development of capital markets, because this would boost the development of pension funds, which are key players in capital markets. This would also have the benefit of enhancing labor mobility in Europe, which is absolutely essential. I mean, we all know Europe is not an optimal currency area, and having more labor mobility would be desirable to keep the countries in the euro. And having portable pensions would clearly go a longer way. And then finally, it would help with the demographic problem, which is, as we all know, a very big problem in Europe. So this is one thing we could do that would tackle at least 3 major issues in Europe: develop capital markets, support labor mobility, and help solve the demographic problem.
You all touched at some point the issue that you need to explain, have a plain or simple language or clear language with people involved in the CMU. So I would maybe like to start with Carsten. How do you educate investors, retail investors or institutional investors about CMU, about the possibilities to make it happen? Because this is one of the crucial items on the shopping list to make it work.
Martin, could I be very concrete and take this example of this panel? I mean, I will not, let's say, follow up to the bashing stories, who did what. I've been serving for 7 years to the Council in different formations: Eurogroup, ECOFIN, Competitiveness Council, and sometimes even the European heads of state and government. When I listen to your statement basically telling that the self-perception of ministers is like we are the saviors of the world, I have to say I've never attended a single meeting where this was either explicitly or implicitly expressed by any of the ministers. In no meeting whatsoever. But it's a little bit telling what you are basically telling us here, how you look at politicians. What do you think about politicians? I think the story starts with that. It tells me that your perception is completely different from their reality. I remember basically in the 4 weeks in June, July this year, we had 19 state secretaries meeting in 4 weeks. 19 state secretary meeting, 10 ministerial meetings, and 4 heads of states and government meetings. Do you honestly think these guys enjoy meeting each and every day in Brussels or even every second day and dealing with these financial problems? And then go out and tell people, oh, we are the saviors of the world? I tell you, starting with Angela Merkel, going down the members list to the finance ministers and to the state secretaries, not a single person enjoys this kind of exercise. They do not see themselves as saviors of the world. But if the perception is like this, and I tell you from the beginning of the crisis, it was exactly the opposite side. On the minister side, the perception was these reckless bankers. Yep. And from that kind of attitude, a couple of activities were started. That tells me there is something wrong in the perception. There is something wrong in the mutual understanding. And it tells me people are not talking enough. And I have seen many sectors, since I'm dealing with many sectors. One of them, and this concerns me most, is the financial sector is extremely self-referential. They love to meet with others because they can communicate easily, they understand this, but out to the outside world of financial sectors, they have serious problems to communicate in a proper way, because they simply use the same language, the same methodology. I mean, I give you an example, financial tax. I'm a trained economist. I share all the concerns that you have expressed. When I talk to people in visitor groups, well-educated people, they do not understand the first argument, that's how it destroys capital market activities. They dispute this, and not only them. I remember very vividly when we had a very long debate in the ECOFIN Council, where one minister, the former Swedish minister Anders Borg, made the same points that were put forward here. And he was heavily disputed by at least half of the ministers in this meeting, saying, well, you're basically wrong, the perception is completely different, our analysis is different, we come to different conclusions. So they are not the saviors of the world, they have similar problems. And sometimes I wonder, and this basically, you prove it perfectly how isolated you are in your thinking when you talk about the FTT itself. The FTT is a price. I don't like it. I would even share your view, don't you ever implement this. But the FTT was a price. The FTT was a price for some of the parliament's approval of the ESM. You may say in the end, okay, the ESM is the European Stability Mechanism that basically helps program countries, for those who are not familiar with the acronym. So I have the same Brussels disease like many other of us. This was the approval, basically the condition of the approval in parliaments to agree on the ESM, on the rescue mechanism. So those who are constantly against it should say, well, the heads of states and government, the ministers should have let fallen Portugal, Ireland, and Greece in order to avoid the FTT. I'm not sure whether you all subscribe, maybe you subscribe to it and say, well, they've done too much anyhow. That's what I read from your statement right now. But this is a political price we had to pay. So that tells me these things are not basically isolated in each sector. So the instrument and then in the financial sector, it has a political component, like any political decision has an impact on the financial sector. And in my personal view, humble view is, we do not have enough bridges to communicate. I know a couple of ministers, not the ones now in the council, but the former ones, they are not experts. They're afraid of all the terminology that people are using. You could have asked basically ministers about securitization, what does it mean? And the first connotation that comes to the mind of ministers is, this was one of the troublemakers of the financial crisis. And I've seen already responses, we may dispute, I do not share this view, this is the perception. So we have to start on this, talking on this in a probably less technical way, find ways, it means I'm not a linguist expert on this, but we have to talk more, we have to explain more, we have to explain better, and we have to change the language. Technical language does not translate into understanding. That's my simple conclusion. And I see this even on our side, and I would not blame the financial sector. The political sector has the same problem, the same language problem. We are not investing enough in this. So it starts with language. We should invest much more. And investing in language does not mean we translate everything in 23 languages. That's not the translation issue. There we invest a lot of money, by the way, in Brussels.
But you come from the council, so how do you change it actually? You create like a gazillion of papers, like...
No, just one of the elements, and that's why I like the informal council, looking forward to have the informal council then in Slovakia, is we invite people to present their views. Probably the ECOFIN is not fairly progressed. I think the Competitiveness Council does a little bit better to have not, let's say, technical experts, but experts from different stakeholder groups to listen and to exchange their views in these luncheons, in these informal parts. This is part of the exercise, but there should be, let's say, a much larger scope. Invite, have dialogues, have even more dialogues. Don't restrict it only to luncheons. Do this even informal meetings in the informal ECOFIN. Slovakia could set an example. I'm talking already, for instance, with the Dutch presidency as well. The trio could set a new example in this kind of dialogue. And then the other thing is basically encourage ministers, chair people of groups to go out, to reach out basically, and not only to communicate within Brussels or in their national capital, to reach out. Jeroen Dijsselbloem was here yesterday, I think, gave a speech. These kind of activities, we need much more of these activities from Brussels, from the institutions, that go out, reach out, communicate, talk, listen to people, try to understand what they are asking, what they are telling, and try to respond in a language that they can understand, and not hide behind the Brussels language wall, basically, where we have these well-trained phrases behind which we can hide and say, well, we use them again and again and again, which nobody will understand. That's my humble view, just on reaching out, talking. We need more dialogue. It does not suffice, basically, to hide behind these, let's say, individual silos and then say, we are right and the others are wrong.
So the sectors response?
Just one sentence. I mean, there's a lot of the things I would agree with Carsten. I mean, on the FTT, I mean, you obviously know why we have to fight against it. I mean, I'm totally aware of the history. We both know that not all political prices which have been given at a certain moment have been paid in all directions. So therefore, I mean, the debate will continue. But on what you said about the phraseology and the linguistic, I would totally agree. But it does not only limit to the financial sector. I mean, just to bring another sector, you know, the very latest abbreviation in Brussels, very much at the mode, is the TCMV, where nobody knew what it was about 5 weeks ago. But this is the Technical Committee on Motor Vehicles. And now, at the time being, I mean, this is the abbreviation which is maybe on top of the hit list. And me myself, in my weekly discussions with my directors, I'm maybe 7 times asking, what the hell is this now? So of course there's hundreds of these abbreviations. Not all of them are avoidable, but you're totally right. I mean, we should do great efforts in this directive, because otherwise we will lose the people.
But I still would like to hear the answer, because let's go back to the bank, to the Capital Markets Union and investors, future one, because as you just mentioned, maybe there is a change of culture, moving from deposits to investing. So how do you do it? Who should be in charge? How do you do it? How do you teach and educate future investors? How do you talk to people, let's say pensioners in Slovakia or in Netherlands, whatever, because you need these people and to understand. And also, you said you cannot expect a carpenter to be a financial engineer. So, but you need these people to understand these things. So, how do you do it?
No, I think as a bank, the reality is that you have all kind of regulation on various layers. We're active in 15 countries in Central and Eastern Europe. Of course, we have to make sure we always observe the national regulation. On top of that, we have to adhere to the Austrian regulation, since in Austria is our head office. And now we are under direct ECB supervision. So, of course, all European regulation also has to be adhered to. This is a fact. And all this is fine as long as we first understand the regulations, and second, they are not contradicting. And I think here is the element where I fully agree with you. We need clarity, we need transparency, and we need the willingness to address the contradictions, because somebody is left over at the end. If I have a board member who is personally responsible for adhering to the local rules, and I, as his supervisory board member, tell him, if you do that, I have a problem with my European rules, one of us, we can both sit there and look at each other and say that we are sad, but we would expect that one of the two regulators would be ready to acknowledge and to start the dialogue which rule now to change to give the real economy and a group like ours an environment where we don't have to live in contradicting regulation. In this sense, I personally perceive it as positive now that, for example, the guidance and steering and regulation for the biggest banks in Europe came under the regulation of the ECB. Yes, it is a hell of a work for us now to do very fast the step from the Austrian regulation to the ECB regulation, but at least I have one final boss, and if they say yes or no, I know me out. I know what I have to do, and I know what I cannot do. And this helps very much. And I think in that sense, it is, on the one hand, important to bring this to the surface. It also needs, on the other hand, effective power structures that bring endless dialogues to an end. And here, I think this is something where there's also an area of improvement. Way too many things end up in we agree to disagree, and we now have to find again some pieces to trade and to balance interests and to see how do we come to a common denominator to move on into one way or the other. And I think this is, in my view, what I would hope from the Capital Markets Union, that whenever in doubt, what should now be the direction to take, that this direction is predominantly driven not by individual political interests of member states, that it is driven by the intention of the regulation. What do we want to achieve? We want to give one unified capital markets where people who offer investments and people who look for investments can meet each other in a relatively simple format. That would be the perfect outcome. And I trust the way you describe it and you attitude it, that if this spirit is realized, then finally the intermediaries as the banks will have an environment in which we know how we can function, and finally the real economy has a benefit because they get easier access to capital and to debt.